All right. Hello, everyone. Attorney Joshua Sells here for today's webinar. And today we are going to be talking about payroll tax, everyone's favorite topic. 941, 944 tax. Of course, if you're joining in, I am sure you know what that is. Just in case, those are the taxes that you as a business owner withhold from an employee's paycheck and then remit to the government, payroll taxes. And those are a very, very high priority item for the IRS. If you are late even a day in remitting those withheld taxes to the IRS, they immediately begin assessing interest and penalties. So this is a very, very high priority item for the IRS. In a book we wrote recently, actually you can see the cover on the screen. We'll be using the screen of the book as part of the PowerPoint, if you will, for the webinar today. But employment taxes are the second highest gross collection that the IRS did in 2018, right behind individual, estate, and trust income taxes. So very high priority item. So just background on the payroll taxes. Again, those are withheld from employees' paycheck. You hold them in trust. Technically, it is not your money. It is the money of the Internal Revenue Service of the U.S. government. And so those are called trust fund payments. You may have heard that. Trust fund recovery penalty. That's something that you may have heard. Definitely don't want to have it applied to you, but those nonetheless are what the IRS calls those payments. So before we get into all the details, again, my name is Attorney Joshua Sells, Senior Tax Partner at J.M. Sells Law, Ohio Tax Attorney, and we have been representing taxpayers who owe the IRS and the state government for many years. And one of our specialties is the 941, 944 payroll tax that the government has definitely made a high priority. So we work with a lot of taxpayers, a lot of small businesses and individuals to get those resolved. Just to kind of give you a little bit of a background, what would happen when you get behind in sending your payroll taxes to the government. Of course, we all know that typically those are due monthly, right? You send those payments monthly, and then you file a return quarterly. That's the typical approach. But if you get behind on that, what will happen is you will get an assessment eventually from the IRS. They're going to make an assessment against the business for those late taxes, for those late payroll taxes, and then eventually they may come after you personally. Now you may be saying, "Oh, wait a minute, Josh. I have an LLC. I formed that to protect myself from liability. They can't come after me personally." Okay, you're right about one thing. An LLC does protect you from liability, but what you're wrong about is the IRS can pierce the corporate veil. What that means is the IRS can say, "Hey, wait a minute, you LLC, we're going to pierce that corporate veil, go through the LLC, and find the person actually in charge, the person who did not submit their required payroll withholdings to the IRS. And now we are going to come after you personally." So not only are we going to assess the business for the back payroll taxes, but we're going to assess you, individual, for a tax fund recovery penalty. And that amount is going to be equal to what you withheld from the employee's paycheck. So the government will hit anybody and everybody that they can. Folks, it's especially at the S corporation context where you may have multiple owners. It is not uncommon to have a handful of people hit with this penalty. The IRS takes this very seriously. And so today we are going to talk about 7 mistakes that IRS payroll tax debtors cannot afford to make. So if you have payroll and you get behind in it in remitting the taxes to the IRS, the number one thing that let me advance my slide. There I am. There a face for radio, as they say. Kind of go through this really. There we go. So let's go ahead and get into it. So ignoring it completely, that's absolutely the worst thing you can do. So talking about the 7 mistakes the IRS payroll tax debtors can't afford to make, ignoring it. This is one of those things where the longer you put this off, the absolute worse it is going to be. So I can't stress this enough. Deal with it. There's no shameless plug here. I'm not telling you like, hey, call us. We'll certainly we would. I mean, we would love to represent you, but call somebody. Handle it yourself. We can talk about why that's not always a good idea later, but it needs to be dealt with. Even if you don't hire us and you hire your accountant or whoever, get somebody to help you deal with this. It is so important. So if you don't deal with it when it first happens, I can guarantee you the IRS is going to begin looking at which individual they can hold personally liable for this amount. So again, they're not just coming after the business, whether it's an LLC, an S corporation, a C corporation, a partnership. They are going to come after you individually. I get a lot of questions sometimes. People will say, "Hey, Josh, my business went belly up. Nothing left. It's over. We have no more cash. I can't send the final payroll withholdings to the IRS. I'm good, right? Because the business went under." Yes and no. But yes, there's relief that may be available for the business since it's no longer operating, of course. But they will likely still come after you personally. And that is an assessment that will be assessed to you personally, and you would owe it just as you would owe any individual income tax. The assessment is preventable. Okay, I can't stress that enough. It is very preventable. We work with a lot of folks who have back payroll tax. The IRS has not personally assessed the trust fund recovery penalty to the individual yet. And there are a lot of ways we can prevent that from being assessed against you personally. So it's going to be assessed against the business no matter what, right? I mean, that's going to happen. But there are ways to handle it so that it does not get assessed against you personally. Again, the key is you cannot ignore it. The sooner that you deal with it, the better. And I hope some of the tips in this book will help you, give you some insight into that. But again, this is a high priority item for the U.S. government. You can see here that it's the second largest amount of gross collections. I mean, we're talking over $1 trillion, okay? $1 trillion. And I mean, just for comparison's sake, if you look right above on the screen, above employment taxes, that light blue, see that orange? That's business income taxes. That's Apple, Google, all the businesses. Okay, so employment taxes are huge. Okay, a big target of the U.S. government. So if you owe if your business owes back taxes, you can personally be held liable, and it's important that you deal with it so that you can avoid that personal liability. The second mistake, I see this a lot. So the business, they decide we're going to go ahead and get this dealt with. We're going to correct this issue. Hey, IRS, I owe back payroll taxes of less than $25,000. Our business is doing better. We just need to get on a payment plan. And they go on their way. They submit the forms. They call their attorney or their CPA, and they get everything submitted. Because here's an important thing. If you get on the End Business Trust Fund Express installment agreement, that plan avoids the trust fund recovery penalty against you personally. So if your business owes less than $25,000 and you get on this IBTFE installment agreement, you won't be assessed personally. You'll avoid the trust fund recovery penalty. That's huge. Okay, and most of my clients, they're under 25,000 in back payroll taxes or pretty close to it. Here's where you see a lot of mistakes. The taxpayer submits the request to get on the installment agreement, and they don't identify that they want to be on the IBTFE installment agreement. Guess what? You're not on the IBTFE installment agreement. You are just on a standard installment agreement. What does that mean? The standard installment agreement means without any other factors, you are being assessed the personal liability. So you get this installment agreement done, you're happy, you are on the road to IRS freedom, and then the IRS says thanks, and here is your trust fund recovery penalty. And you sat there scratching your head, why did I hire that guy, or why did I do this? I thought I was avoiding that. A lot of people don't realize, even practitioners, that you have to specify the IBTFE installment agreement when you sign up for a payment plan for payroll taxes. Critical, very, very important. Cannot stress that enough. Second point here, let's say you owe $26,000 in payroll taxes. You don't qualify for the IBTFE. Sorry, Charlie, you're going to get the payment, the personal assessment against you. However, if your case has not been assigned to a revenue officer, pay down that $26,000 to get below $25,000, and you now qualify. Huge. I cannot stress that enough. So important. If you're close to that $25,000, borrow from your uncle. Take it from your 401k. You never thought you'd hear that, right? Take it out. Get that paid down. Do something to get that below $25,000. Huge. Very important. However, if it's already been assigned to a revenue officer, whatever the tax liability of your back payroll taxes is on that date, that's what it is. It doesn't matter anymore. Okay? So if it's not assigned to a revenue officer, if it's still with ACS, pay it down. Get it below that $25,000. Huge. All right, going on to the third mistake that IRS payroll tax setters cannot afford to make. Form 2750. I really don't understand why practitioners don't use this more. But if you don't qualify for the IBTFE, let's say you owe $40,000, there's no way you're coming up with enough money to pay that below that $25,000. Okay, you're thinking, oh boy, I'm getting the personal assessment. And I would tell you, yeah, there's a pretty good chance. However, Form 2750, it waives the statute of limitations for the assessment. And you may be saying, why would I ever want to do that? Well, here's the big point I'm trying to make. This is a bargaining chip. The revenue officer, they're not going to, by default, offer you this. But the Internal Revenue Manual gives them discretion. If you say, hey, I'm going to get onto a payment plan, I'm going to eventually pay all of my back payroll taxes, and instead of assessing me personally for the trust fund recovery penalty, I'll sign a Form 2750 extending the statute of limitations so that I won't have to be assessed personally. Typically, the revenue officer is fine with that because the Internal Revenue Manual gives them authority to accept that. Now let me go ahead and throw this out there. If this isn't your first rodeo, like if you go through trust fund recovery penalty on an annual basis, they're not taking this. You're being assessed personally no matter what. Okay, so if you're a repeat offender, you will definitely have the trust fund recovery penalty applied against you personally. But I want to be very clear, this is a bargaining chip. Know that it does waive your rights, but it's one that can absolutely help you avoid personal liability. If you're with another law firm or accounting firm and you haven't heard anything about Form 2750, bring it up. Talk to your counsel about it. But this is a huge bargaining chip, so you don't get that personal liability. And again, I encourage my clients, be informed of the process. Okay, don't just assume because you hired somebody that that everything's going the way it should be. Be involved. Okay, I tell my clients, hey, if you don't hear from me, if I've got behind on some work, call in, stay on top of me. I'm pretty good about making sure that that doesn't happen. But this is your future that's on the line here. Be involved. Be involved with it. So definitely make sure that Form 2750 is being used. Huge, huge bargaining chip. Again, this is just a tax fund recovery penalty case file check sheet. What the revenue officer does is pretty well documented. Your counsel, your CPA, your EA, they should have these. That way you know exactly what's going to happen. I can tell you what the revenue officer is going to do depending on where we're at in the stage. So they take these TFRPs very seriously. So it's important that you kind of know what they're doing right from their playbook. All right, number 4, talking about the 7 mistakes the IRS payroll tax debtors can't afford to make. Now, I told you Form 2750, great thing, beautiful, sign it, right? Form 2751, I don't know why they put it right next to 2750, but 2751 is not something that you are likely ever going to want to sign. Very few limited circumstances where this would be a good idea. Never, ever sign 2751 unless you've personally talked with counsel about this. 2751 tells the IRS that you agree to be personally assessed the trust fund recovery penalty. And not just that, you're telling the IRS that you agree you were at fault. You're accepting full liability. Not just that you agree to be assessed, but you're assuming full liability in the underlying action. That's a huge deal. Be very careful about signing this. If CI or the Department of Justice is also investigating you or your business, I would not sign this. This is saying that you intentionally did not remit your payroll taxes. Hey, guess what? If you don't sign it, you're still going to be assessed. It's just 60 days later, and you haven't fully assumed the liability in that sense. So I can't really think of a good reason to sign this right now. I just wouldn't. Just make a black and white rule, unless your tax lawyer tells you otherwise. Do not sign Form 2751. Kind of a general rule. I always tell my clients, never sign anything that the IRS gives you unless you are 100% sure you know what you're signing. You generally, for the most part, cannot unsign something. So make sure you know what you're signing. If you see the number 2751 on your form that you are getting ready to sign, I would slow down and give an attorney a call, because that's not a form you want to be signing. Number 5, kind of getting through this, guys. We got 3 more to go here, but number 5, the 7 mistakes IRS payroll tax debtors can't afford to make. Having unfiled returns, 941, 944 forms, current and compliant. Though if some of you have worked with me before, you've heard me say that you have to be current and compliant before the IRS will work with you on resolution. So one of the first things I would do if I was working with you, we're pulling your transcripts, your business's transcripts. We're going to find out what are the missing tax returns. Are they quarterly returns, income tax returns? What are the missing returns that need to get filed? We will get those filed. Then we will work on getting you current with your quarterly withholdings and your monthly payroll deposits. The IRS will not work with you if there are outstanding returns or you are not making efforts to be current in your federal tax deposits. It is huge, very important. That's the first thing that we're going to do. We're going to pull those transcripts. Yeah, I get it. It's a lot of work. You got to go back many years sometimes. It's tedious work, but you have to do it. That's a process that we have in our system that we do that for every single client. You may be saying, Josh, you mean even a client you've had before? Yep. Even if that client was with us 6 months ago, I'm still pulling transcripts. I'm doing it every single time. Huge, very important. You don't want to get through all your resolution, all of a sudden the IRS kicks it back and says, sorry, you're missing a 2017 return, or you're missing this year's quarter one payroll return. You don't want that to happen. That's a waste of time, waste of money, waste of resources. Not to mention all that time that's passed, you've now accrued more interest and penalties. So make sure you have all of your forms filed. Again, there's a copy of a tax return transcript for a John Doe taxpayer, just a sample. But it's a lot of paperwork to get through, but it is absolutely necessary. All right. So the next mistake, and again, we talked about this already, but not paying down your payroll tax debt. And we won't spend too much time on this one, but if you're close to that $25,000 threshold, remember, that gets you on the express plan, which avoids what? The personal liability. If you're close to that threshold, pay it down. This has to be done before a revenue officer is assigned to your case, though. When that RO gets assigned, that locks the amount in as far as qualifying for an installment agreement. All right, final one. We're on the home stretch here, guys. Not getting loan letters. Now, you may be saying, what in the world does this mean? Am I supposed to get loans to pay off my payroll tax debt? Well, if you can, wonderful, because the IRS is going to expect you to do that. Okay, that's how serious they are about this. If your business has a lot of assets, for example, and you owe over $25,000, that's that magic threshold. If you owe under $25,000, give me a call right away because we can deal with that today. That's an easy one. Okay, but if you owe over $25,000 and your business has assets, absolutely the IRS is going to expect you to tap into the equity. However, a lot of businesses and individuals, for that matter, when they get to this point where they're not remitting payroll withholdings, typically their credit has already taken a dip, and so it's going to be hard to get loans. And so what I tell my clients when they come in and see me and we go through their situation, one of the very first things I tell them, go ahead and apply for 3 different loans, online, in person, however you want to do it. 3 different banks. I typically say go to a big name bank, a community bank, and then pick your poison, pick a third one. And I want you to get 3 loan denial letters. What does that do? If you have those loan denial letters, I can go to the IRS and be like, look, they have tons of assets, but no way of accessing the equity. Because how do you get to the equity of an asset aside from selling it? You get a loan against it. And if a bank's not willing to give you a loan, that equity is useless, and we can take it off the books as far as the revenue officer is concerned. It makes it a lot easier to get into an installment agreement situation instead of the revenue officer saying, yeah, you're just going to have to get loans on all your equipment. Okay. Typically, they're not going to make you sell your assets, especially if you're a business. Why is that? Because without your assets, you're not going to generate income. Okay, you're going to be in a worse off situation. The IRS knows they'll probably get less money recovered that way. So, I mean, unless your business is sitting on some luxury assets that have nothing to do with generation of income, I typically tell my clients I wouldn't lose sleep over the IRS making you sell those assets because it's probably not going to happen. But absolutely, they're going to want you to get a loan on those assets. So you get me those 3 letters, I can go to the IRS and say, hey, that's not happening. This guy's credit shot. Here's 3 letters to prove it. And that's why we go national bank, regional bank, and then pick a bank. Because that way I can tell them, look, we've tried a lot of different options. So get those loan denial letters. Save them. You are going to need it. Okay. Again, just a little little picture of a loan denial letter. So with that, we are actually finished with the 7 mistakes IRS payroll tax debtors can't afford to make. If you have any questions, feel free to ping them in the chat box. We're going to stay on for a little bit and take some questions. And with that, let me go back to the main screen. Okay, and put my mug shot up there. Sorry, everyone. It is what it is. Okay, there's that mug shot. So let's go ahead and take some questions. So we do have a question coming in. Okay, this is from Mary, and Mary is in the Cleveland area. Okay, and used to work up there, beautiful city. All right, so Mary is asking if a revenue officer comes to the business, are they allowed to look around? Well, Mary, yeah, they absolutely are going to want to look around at the business, and depending on the type of installment agreement, the revenue officer is going to make a site visit. Okay, so I'm assuming by your question you may have had that happen already. Yeah, they are. As far as for the trust fund recovery penalty and the late payroll taxes, yeah, they are. If you're getting onto some kind of installment agreement, they likely are going to do a site visit. I tell my clients generally you do not have to let the IRS in, but if going to the IRS saying, "Hey, I want an installment agreement," a lot of times they're going to require that site visit. But if it's got to that point, I mean I can't stress this enough. Again, this is not a shameless plug for me, but get some. You need an attorney. Okay, the IRS agents are trained to get information from you, and having an attorney there can mitigate a lot of damage, a lot of issues. Okay, I could tell you horror stories where clients, unbeknownst to themselves, said something, and the IRS used it against them. It absolutely is like court in that way, where what you say can and will be used against you. All right, let's go on to the next question. Now we have Pat in Columbus. Thank you, and let's see what he. So Pat is wanting to know. Okay, so good question. Yeah, so that's a great question. So your business is not doing well. You've closed up. You have this payroll tax. All this information is great, right? But how can you afford an attorney if that's the situation where you're currently at right now, where you obviously have lost your business, you've lost a source of income, and now you have this huge payroll tax, probably at that point a trust fund recovery penalty. So how can you afford an attorney? I can't speak to anybody else, but I mean, I can speak to our law firm, Pat. So what we do, we have what's called phase one. Phase one is when we figure out exactly what you owe the IRS, any missing returns, any missing deposits, and then we create an investigation and liability report, so you know exactly where you're at, and we create a roadmap on how to overcome that. Remember, I said we have to pull transcripts. We're doing that in that phase, so that's 299. And then for the second phase, we gave you that roadmap. Here's what your future resolution looks like. Maybe we're able to settle with the IRS for a fraction of what you owe. Maybe we're able to fight some of it, remove some penalties, maybe we say the tax is not accurate, and we get that adjusted, whatever it is, and then we give you that roadmap of what full resolution looks like. And then if you decide to hire us, at that point we apply that $299 towards those legal fees. And most of our clients do not pay the full balance. We actually have financing options. Most of our clients opt for that because, especially if you have okay credit, it doesn't have to be wonderful, just okay credit. We are able to offer financing, and your payment with us is typically $60 to $90 a month. That's the lower range. Some of our clients who, a big case, lots of filings that have to be taken care of. It could be $120, $180 a month. But we make it affordable. We break it down so that it is affordable. Again, we work with 10 different lenders. You can have a credit score as low as 550, and we can still get you qualified. Again, our goal is to make legal services affordable so that you can get out of debt from the IRS, get the IRS off your back, and get on that road to IRS freedom. Pat, hopefully that answered your question. Again, if you're not a fan of financing, of course, obviously we take credit card, debit card, and check payment. All right, so let's see. Any other questions? All right, let's see. We have Timothy. Timothy, and where is Timothy at? Timothy is in Kent, Ohio. Kent, Ohio, close to where I used to live when I was a few years ago. So Timothy is asking. He got apparently the trust fund recovered penalty has been assessed against you personally. Yeah, correct. That's a personal assessment at that point. It's just like you've been, your income taxes were late and they've gone into collections. It's going to be handled the exact same way, Timothy. So your question is about what can they take. Obviously, our goal, getting involved earlier than later. We're able to stop wage garnishment because they can take wages. We're able to stop levies of your bank account because they can do that. So absolutely, when we get involved, when we represent you, all of that stuff stops. Okay, so you don't have to worry about any of the collection activity. So to your question, what can the IRS take? The easier answer would be, or the easier question would be, what can't they take? Because pretty much anything is open to the IRS to take. They can take money in your bank account. That's called a bank levy. Okay, and we can talk about that actually. There's some little tricks there, tips, and that we could provide you. The bank takes the money out, and then the bank actually holds it for 21 days. So you actually can make an argument that I need that money. The bank can release it. The IRS doesn't take it for 21 days, even though it's disappeared. If money's disappeared from your bank account and it's an IRS levy, call me immediately. We can probably show that you need that. We can get that back. But anyways, that's another topic for another day. So bank levies, wage garnishments, yes, they can take Social Security, VA benefits, absolutely. Those are actually pretty hard to get back because the Treasury is sending those out, and the IRS is the Treasury, so it's pretty easy for them to stop. But that's a huge bureaucracy. So once those kind of garnishments happen, it's a very difficult situation to remedy. They can take vehicles, they can take guns, paintings, they can take vacation homes, timeshares, anything of value. In Seattle, Washington, there's a lot of taxpayers have vacation homes up in that Seattle region, and the IRS ended up taking so many vacation homes, seizing them, those second homes, that the IRS actually had to hire a property management company because those vacation homes had renters in them. Okay, a lot of people were buying these vacation homes to rent out, and because of the laws in Washington, the IRS couldn't just kick the renters out. So the IRS actually had to hire a management company to manage those properties. That gets us down to primary residence. Can the IRS take your primary residence, your house? The legal answer is yes. Okay, it requires a district court judge to sign off on it. The practical answer is no. The IRS is not in the business of putting people on the streets. I think last year or the year before, the IRS took two primary houses, primary residence. And the reason being that those were some egregious situations. I think those taxpayers actually are in jail on tax fraud and evasion, multi-millions of dollars, and just really bad cookies. I mean, a lot of criminal activity going on there. So the average Joe is not going to lose their house. If you have one of these national firms calling you, I know if you have a lien filed against you, you probably are getting bombarded by telemarketing. They like to use scare tactics, and they'll tell you you're going to lose your house. Hang up the phone. Okay, I think that's nonsense. I mean, seriously, you're being hounded by the IRS. That's scary enough. If another firm is giving you scare tactics to try to make you act, hang up the phone. Okay, you are not going to lose your house. So Timothy, hopefully that answered your question. So again, we are actually out of time. We're looking forward to doing more of these webinars, providing information to people who are in need of it. Again, if there's anything that our law firm can do for you, anybody who's listening to the webinar today, we would absolutely love to be able to help. So I'm going to put our phone number up here, and you can see it there on the bottom of the screen. Again, we are a law firm, an Ohio law firm, helping Ohio taxpayers. We are local. Okay, we have one office in Northeast Ohio, getting ready to open a second office down in South Central Ohio, and eventually a third office up in the northwest part of Ohio. So our entire goal is to be accessible to you, to be affordable, and to get you real solutions. So if there's anything we can do, if you just want to even call for a free case analysis, absolutely, one of our attorneys would do that with you over the phone. Just give us a call at 330-331-7611. Again, that phone number is 330-331-7611. And we absolutely would love to help you. No obligation for just calling in. We'd love to be able to kind of tell you exactly what you are looking at as far as resolution, and again, give you a ballpark figure. And again, we do offer legal fee financing. I know attorney fees can be a scary thing, and rightfully so, but we want to make it affordable. Most of our clients end up with a payment of around $60 to $90 a month. And again, if there's anything we can do, give us a call. Hey, thanks so much, everyone, for listening in today. I hope this was a help. If you are in this situation, use some of these tips in the webinar that you learned today. If you'd like a copy of our free book, call the office. We'll send that out to you. We'll send a copy of 7 Mistakes IRS Payroll Tax Debtors Can't Afford to Make. We have another book as well, 7 Ways to Remove a Tax Lien, a practical guide for 1099, small business, and self-employed taxpayers. So we would love to send you some literature just to be a help to you. Again, have a good day, and thank you for watching. Attorney Joshua Sells signing off.